Hello and welcome to the i3 podcast, Conversations with Institutional Investors. My name is Wouter Klijn and I'm the editorial director for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. That's the letter I and the number 3-invest.com. There, you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners from around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. Please enjoy the show. In this episode of the i3 podcast, I'm joined by co-portfolio managers James.Abela and Maroun Younes from Fidelity International. And we dive into the world of small and mid-cap investing, a $12 trillion market. James and Maroun explain why they believe this part of the market remains one of the most attractive hunting grounds for investors, despite a lot of attention going to the Magnificent Seven. We talk about how market concentration in the US has distorted returns, where they're finding value globally, and how their investment framework, built around quality, value, transition, and momentum, helps them stay balanced through shifting market cycles. We discuss a number of case studies, including networking equipment company Arista and FICO-score provider Fair Isaac Corporation. And of course, we touch upon one of the biggest themes of this decade, AI. From the risks of an AI bubble to the practical ways it is changing their own research process. Welcome to the show.
Thank you. Hi.
So why small and mid caps? What got you started in this particular space of investing?
Well, for me, I started in the Australian market in Aussie mids and smalls, but we were asked by clients to move into the global space. That's where Maroun's joined me to attack this global market, which is huge. The attractions are significant. There is a very, very big market. The size of the market is 9 trillion US, which is huge. So 12 trillion Australian. So it's 5x the size of the Australian market. So the opportunity set is significant. The breadth and depth of stocks is very significant. So the number of stocks you can own in the universe in each sector or in each theme is quite broad and diverse. Valuations are very attractive. And one of the other key things is that they are still under-researched and in many cases underappreciated for what they actually have in terms of quality. So that allows Maroun and I to find ideas that are often 15 to 20% EPS growth on 15 to 20% ROEs, trading on very reasonable multiples compared to things that are more discovered in large caps. And the size we can now go up to is about 60 billion US, which is our universe scope, which gives us quite a long runway in terms of years of holding stocks before they are large caps. So they're all the key attractions. So it is a very attractive space.
So we've seen a lot of concentration in particular US equity markets, and we did see that earlier this year's small and mid caps have underperformed a bit. Are the two linked? Is the concentration in the market affecting the small and mid cap space?
Yeah, absolutely. So they're two sides of the same coin. So you've basically had in the US market a concentration of maybe half a dozen stocks, predominantly in the technology sector, and they've been doing incredibly well. So they've propelled the market a lot higher, and they've allowed large caps to outperform small caps. That's quite unusual. Small caps historically, if you look back 25, 30 years, small caps historically have outperformed large caps. They're smaller, they're growing off a smaller revenue base. It's much easier for them to double and triple in size over time. But certainly over the last maybe 5 or 6 years, that's not been the case. So it has tempered some enthusiasm, I guess, in the past for smaller mid caps. But I think you're also starting to see people now waking up to the risks associated with the concentration levels, both at a stock level as well as a sector level, and people actively now looking to diversify away from that.
Yeah, so you don't see it as a structural change. The small cap premium is still out there. It might be just a temporary dislocation.
I think so. If you look back in history, there has been periods in time where large caps have done quite well. If you look back to the Nifty 50 back in the early 70s, there was a handful of stocks that did incredibly well, predominantly at the top end. So we do go through periods every so often, and I think this is another one of those episodes.
Yeah, so might be a nice buying opportunity then.
Absolutely, yeah. We definitely think so.
Yeah. So we've looked a lot at US exceptionalism, a lot of talk around that, especially the Magnificent Seven. But, is it the broader market, or is it just the Magnificent Seven that are exceptional? Or do you see that also extended to the smaller mid-cap space?
Yeah, with US exceptionalism, it's a very big topic area. So what we focus on, I guess, in our world is returns, and the return profile of the mega caps is quite high still. They're in that 20% level in terms of ROEs or ROICs, return on invested capitals. Our index is still around that 15 to 16% level, which is quite high, and also the US in aggregate compared to the rest of the world is very high. So 15 to 20% returns on capital compared to the world average of around 9s to 10s. Whatever you want to call it, like the US is 50% better on average in terms of returns on capital to the rest of the world. So we are still, half of our fund at least is in the US. There's a lot of talk about, the US builds great businesses, the Chinese build great manufacturing, and European builds great regulation. It's a well-known kind of cliche. But the fact is that the US does have great businesses, whatever you want to say the cause of that is, and that's expected to continue, especially for the next few years.
Yeah.
So we don't think it is a one-off, and it's not just the Mag 7 either. Mag 7 are symptomatic of the US being a leadership marketplace. And that's why we find it very attractive, because in global mids and smalls, we've built a portfolio which has returns on capital of in the 20% range as well, and still a very reasonable valuation. So yeah, we aren't too concerned about that concept of US exceptionalism, because we don't think there's a huge break point that's obvious coming forward.
So there has been a lot of talk around whether we are in an AI bubble or not, and whether the Mag 7 is a symptom of that. What's your take on it? Do you have any views on whether we're in a bubble, whether we're just in an expensive period? Or?
Yeah.
It's always hard to know whether you're actually in a bubble or not, but certainly there are signs, early signs of formation. There's a lot of spending going into this area, and at this stage we're not seeing the return on that increased capex come through. Now it may still come further down the track, in which case all this spending is justified, and things continue as they are. But when you're seeing an increasing level of capex, I mean, some of these companies in the Mag 7 are spending 10x the amount of capex they were 10 years ago. So they were capital-light businesses, and now they're quite capital-intensive businesses, spending a lot more money. That money needs to earn an attractive rate of return, because one of the things these businesses have done historically is deliver very high rates of return. So when you're investing a whole lot more money, and you're large and you're dominant, the hurdle rate for you to keep on growing becomes incredibly high. So I guess we'll see over time whether this ends up being a bubble or not. But certainly there are some early signs that this could head down that path.
Yeah. So most people talk about the Mag 7 when they think about AI and AI development. Are there any opportunities in the small and mid-cap space that stand out?
Yeah, so we're seeing quite a few of those, and we have a few of those in the fund itself. They don't dominate the headlines; they're not household names, but a lot of them are in what we call the enabler space. Right now, they're either doing things like advanced packaging and hybrid bonding, or certain techniques such as power efficiency in industrial end markets. We go through this in quite a bit of detail. Recently, we did a webinar, probably about half an hour. We went through AI in detail and what it means for our universe, and we even had our sector lead, our technology sector lead, dial in from Hong Kong through the webinar as well. So if people are interested, I'd encourage them to have a look at the webinar for quite a bit more detail.
Yep, and we'll put a link in the description. So let's have a look at your process, your investment process. There's 4 areas that you focus on: quality, value, transition, and momentum. Why these 4 elements?
They really allow you to keep a balance style through the whole sort of movements of the market. So markets can be like what I call quality momentum cheerleading. It can be a bear market where value and transition kind of works much better. There can be very thematic elements of the market. So this allows us to be basically balanced, but also have guardrails that make sure we're not too extreme in one particular style factor. Specifically, like quality is quality compounded, so high return businesses that are long duration. Value businesses are typically lower valuation, but at least the balance sheets are good and they're not in some strategically declining marketplace. We're happy to hold those if they're just out of favor. Transition names can be turnarounds, they can be cyclicals on the recovery, or they can be innovators. And then momentum can be top of cycle cyclicals, top of cycle thematics, or things that are just like in a hot sort of thematic as well. So those four elements is how we think about it. Now we think about it in terms of risk as well. So that allows us to think that your blind spots and your winning spots tend to be governed by where the stocks are on that journey. So we have different sort of funny names like quality is a love quadrant, value is a neglected quadrant, transition's the quadrant of hope, and momentum's like the nightclub quadrant or the hot quadrant. It's where things are lots of fun and things are going up.
Is that how you label stocks as well? These are the hot stocks and these are the neglected
Well,
stocks?
they get labeled in QVTM, so they get labeled by that. But your brain definitely is wired to where that is. So, for example, the quality quadrant is love quadrant. Like a long-term marriage or a long relationship, you get very comfortable, you get very complacent. So the risk is, and this is business. So this is competition, capex, complacency, arrogance is what can set in when you're a high-quality stock. If you've got something that's unique, and we've found things that are unique have 20% returns for, say, 10 to 20 years, that can happen if you are offering something very unique, but you have to work very hard for that to work for 20 years.
So does that help you in managing sort of also the risk of falling in love with a stock or
Yes,
developing biases
correct,
towards stocks?
exactly. So it's at the individual stock level, yes, you are trying to manage the individual stock risk. And then at the portfolio level, you're trying to manage factor exposure risk, and you're not trying to, for example, in 23 and 24, those years were very much quality momentum markets, where a lot of it was generating alpha from PE expansion or earnings upgrades. So what you end up having, you're managing risk at the stock level and the portfolio level. And what you also then have is a spread of businesses that are like four sort of types as well. So quality compounders, which are those beautiful compounder stories, cyclicals, so your value, transition, momentum kind of triangle, cyclical, low, mid-cycle, top cycle. Then you have your innovators, which go from transition to momentum when they're going from generally low returns to high returns, and sometimes they can move over into quality if they can sustain that for many years. And you got your thematics, which are generally momentum. So there's these four types of stocks that you can own, and they're on very different journeys. What they're doing in terms of share prices and returns and multiple expansion is very, very different. But we've made alpha in all of those categories, those four stocks types that I mentioned. So we do it for stock picking, for risk, to make sure our head's in the right space, but then also to make sure the portfolio is generally balanced all the time in a market that can do well in up markets and down markets.
Yeah, and do you have certain ranges that you move in between quality and value and momentum, or do you try to get a style neutral type of approach?
Yeah, we have guardrails. It's based on a 25-year back test. It's 40, 30, 20, 10 actually. So quality 30 plus or minus 10, 40 plus or minus 10, value 30 plus or minus 10, transition 20 plus or minus 10, and momentum 10 plus or minus 10. And as long as we're within those ranges, then our rolling 3-year outperformance, should always be positive. That is the goal. And that was based on a 25-year backtest using the UBS Holt system.
So value has been sort of unloved for quite a while until sort of the Ukraine war happened. How do you hold on to that allocation? Because it can be quite painful, I think, sometimes during the cycle.
Yeah.
Yeah, it's different types of value. So a lot of it is cyclical. So you can have energy going through a different cycle that's not tied to the broader, value versus growth. We've made money in energy. We've made money in insurance, getting in and out. Again, insurance has its own cycle depending on when there's catastrophes and when you have a hardening or an increasing in premiums and a softening that's taking place. A lot of these things are really related to demand and supply dynamics within their tight little industry, because supply is quite lumpy. It comes on in chunks, and so you might get periods where a lot of supply comes on, and you get an oversupply, and the respective prices for that industry drop, and then you get a period of no new money coming in because returns are quite low, and lots of companies are losing money, and then you get a demand spike, and that actually pushes up pricing, and supply's got a lagged response. So we're not looking to play the quality versus value macro cycle. When we're looking at cyclicals and value names, we are looking at them at a stock by stock or industry level basis.
So quality, value, and momentum are probably, well-known style factors, style approaches. Transition is a bit different though. And when you talk about transition, you're not talking about the energy transition. What do you mean exactly by transition?
Yeah, look, I think James alluded to it a little bit in one of his earlier responses, but transition really is, we're talking about a change in the business model. So it could be a turnaround. You could have had a business that's been underperforming for a long period of time. You get a new CEO come in place. There's a cost-cutting program. Potentially there's divestment of non-core assets. The business is going to refocus on areas that it competes well in, and forget everything else. So that would be a transition name. You could also be a biotech stock or a early stage technology name. And you're going through that journey of, you're still loss-making now, but you're building up scale, and in another 6 to 12 months, you're going to hit that profitability mark, and you're going to be break-even, self-funding, and then on that path to increasing margins and returns over time. So when we're talking about transition, it's not the energy transition; it's a fundamental transition or a fundamental shift in the business itself, either the business model or just moving through that life cycle.
So you recently wrote a piece on a case study that you invested in, Arista, which is a networking equipment company. Now, there was sort of an interesting situation there where there were concerns around whether they would keep their main client or whether they were potentially cut out of that ecosystem. And you went there, you talked to management, and you got a clear picture. But is that the type of transition you're talking about, or is that just a catalyst that you're looking for when investing in particular companies?
Yeah, so Arista itself, we actually classified it as a quality name, not a transition name. It was a high quality business that had been doing incredible margins and returns over a long period of time, and it had been outgrowing the broader market. So for us, it was a long-term quality compounder. But you're absolutely right. The opportunity was caused by dislocation, and that dislocation was so Arista at that point in time had and still does have two large clients, being Microsoft and Meta. And this is back to 2020. Meta had basically come out and said that they're delaying their CapEx spending, and a lot of the market participants thought that was Meta's way of saying that they're going to be spending less with Arista and a few other people. Now, myself and the technology team went to Silicon Valley. We met with both Arista and Facebook at the time, and it was very clear to us that the issue why Meta was actually postponing its spending was to do with the Intel chips that it wanted access to rather than anything else, and that they were not looking to move away from Arista in the network switches department. So for us, ideally, yes, you want to look for a dislocation. You want the market to be concerned about something, and then for you to have a differentiated point of view, because that really is where the mispricing occurs, and we're looking to take advantage of those situations. So even though Arista wasn't a transition per se, there was a temporary dislocation for about a year or so until the market gained comfort that actually Arista is not losing any share from Facebook, and Facebook remains a loyal customer. But it was that temporary dislocation in price that we took advantage of, and ended up being quite profitable for us.
Yeah. I presume that it doesn't happen all the time. Do you stumble upon these occasions regularly where you find that the market is interpreting certain data in a certain way, but when you actually talk to the company, it turns out to be another way?
Yeah, I can give you a recent example. One that we were looking at for a long period of time is called Fair Isaac Corporation. So you may or not know, but in the US, there's a thing called the FICO-score, which is effectively your credit score. You need that to get you need it to get home loans, auto loans, lots of different things. And it's called FICO because it's Fair Isaac Corporation. So this company has effectively had a monopoly on credit scores for decades. Anytime you need to get a loan, you go to a bank, they request your FICO score from FICO, it comes back. If your credit is worthy enough, then you sort of get the loan and off you go. Now, recently what happened was the head of the Federal Housing Authority, the FHFA in the US, Bill Pulte, who was appointed by President Trump, came out and tweeted that FICO have been raising their prices quite aggressively. And they have. FICO score back in 2019 or 2020 cost you 50 cents. And now it costs you $4.50. So it's gone up ninefold in 5 years. But $4.50 in terms of the cost of buying a home, when you think about things like land taxes, when you think about insurance, and all sorts of different fees that you pay to real estate agents, it's actually a tiny part of the entire thing. But in percentage terms, these guys have been increasing pricing 50, 60, 70% year on year for the past 4 or 5 years. So, the share price in FICO corrected quite aggressively. It was sort of $2,200, $2,300 a share, and it sort of came down to about $1,400, $1,500 a share. And for us, speaking to the company, understanding how reliant the lenders are on a FICO score, and there is a competing product called Vantage Score, but it's not anywhere near used as much as FICO. And a lot of the systems in terms of lenders, the mortgage, the guys that securitize loans and sell it as MBS products to end investors, all of their systems are all set up on FICO score. So the incentive to switch is not really there. And then when we spoke to the company, they still had views about creative ways in terms of they can increase pricing going forward. So for them, it wasn't deterring them whatsoever. And so we took advantage of that. And then recently, within the last couple of months, we've actually seen them come out with a unique way of changing their pricing and still getting effectively 100% year-on-year price increase, but just doing it in a way that is quite innovative, cutting out the middleman. So the end customer is still paying the same, but they get twice the revenues for themselves. And the FHFA came out and said, we're actually supportive of it. So this is a business with pricing power. But again, a temporary dislocation, the shares were down sort of 30, 40%, and you could sort of get in there, do the research and walk away with a differentiated point of view and take advantage of that dislocation.
Yeah, for sure. So you're keeping a close eye on Trump's tweets as well then, to see if it's any opportunities there?
Look, his tweets are always creating opportunities. It's basically creating opportunities on a daily basis.
Either that or chaos. So if you look a little bit at your selling discipline, so I saw that last year there was a time that you trimmed some of the stocks because you were looking at the PE ratios that were quite high. Can you tell me a little bit about how you stick to that selling discipline, even in markets like today, where it still seems to be going up all the time, but obviously you have to take profit at some stage?
Yeah, so we've got different reasons for selling, and one of them could be the thesis is broken, right? So we assumed something was going to play out with this company. It's not looking like it. Our initial assessment is incorrect. And we need to get out because it's not what we thought it was. That's a bit different to what you were alluding to, and you're absolutely right. Another reason why we would sell is where the valuations, are no longer representing a mispriced opportunity. And we are relatively sensitive to valuations, even though we do like quality names. We're not going to go out and pay crazy multiples for it. So, if I go back to last year, the middle of last year, we were overweight the US, and towards the end of the year, we found that a lot of names, predominantly in the US, had run up so much and well ahead of their fundamentals that we were taking profits in some of these names. And when we were recycling them, we were just finding more relative value opportunities in places like Europe, for example. So we went from the middle of last year being overweight the US towards the end of the year being underweight the US. And that was really just because of risk management, right? We just wanted to make sure that the valuation of the portfolio level was manageable, because you don't want to be susceptible to large drawdowns if you get a bear market, if you get rates moving up, if you get value sort of having a strong style rally. So we manage that as well at the portfolio risk risk level. So what we were doing last year was more around the valuation side. And it ended up being predominantly moving away from the US into other areas.
Yeah.
Also for last year was particular the timing question you asked, because 23, 24, Maroun and I noticed a lot of the performance of the stocks was from PE expansion. So that's fine if there's earnings underneath that. So yeah, we haven't had to chase stocks on 40 or 50 times PEs, for example, to try to get alpha. A lot of the times they're buying stocks on 20 to 30 times PEs that are good quality businesses. But we've also held stocks that have held on to stocks that have gone up 400 to 500% because the earnings are actually moving up in that quantum, that magnitude. So Apple Oven, for example, we still own today, that is up 4 or 5 times from our original purchase, but the earnings numbers are actually a lot higher, 400 to 500% higher. But then also, if you look out 1, 2, and 3 years, the earnings continue to grow at very high levels. So that also makes sense. But if it doesn't make sense, and why we did trim a lot of the stocks, like for example in US industrials, the stocks normally traded at 10 to 20 times multiples, and they're trading at 35, 30 or 30 and above PEs, and the earnings growth was 5-6%. So the analysts getting nervous. We're like, this is getting a bit, and so that's when it's a bit more dangerous in our views, that the multiples have expanded but the earnings are not there. Yeah. And then if you roll out year 1, year 2, year 3, the multiples are still high relative to history, high for the growth, and high in absolute terms relative to the market. So that's why you got to, that context is what we constantly think about. And like Maroun said, if the thesis is broken, that's definitely a sale. But then also the valuations just don't start to make less sense to us, then the mispricing is not there, and then we will trim or exit.
And how do you look at the individual companies placed in sort of the broader market environment? Because we are in sort of an unusual period where it just seems that equities just keep going up. I mean, we've seen a lot of super funds that basically said the market is expensive, we're taking risk off, lower equities, and then just continue for another 3 years.
Yes.
And it might continue for another 5 years. How does that change your thinking in terms of portfolio construction?
Yeah, I mean, our view is that we're hired to solve the investment piece. So we're not really trying to make a big call from equities to cash. So we have a bit of flexibility in terms of cash, but realistically, cash for us most of the time is sort of 5 or 6% or below. Yep. We're not going to sort of go out and say we're really negative on the market, we're making a big market call and we're going to go to 20% cash, for example. That's just not what we do, because ultimately what our clients are hiring us for is we want you to solve the equity piece, and we assume that if they're getting nervous about valuations or equities, they can make a move themselves at their portfolio level, whether it's an individual, whether it's an institution, they can shift some money out of equities into cash. But that's sort of not for us to make for them. Having said that, we do keep an eye on the market levels. We're looking at sentiment, we're looking at euphoria. And so within equities, sometimes we can sort of move a little bit more defensively out of higher beta names, out of names that are more exposed to the economic cycle. If we feel as though we are going more towards top of cycle, we might go into things like a bit more defensive healthcare, consumer staples, where we think they're going to be relatively unaffected even if you go through a recession or anything like that. So we're making those sorts of decisions, but we're not going to be sort of moving the portfolio from 100% equities to 80% equities and the rest in cash.
So how are you positioned at the moment in terms of those that balance between defensive sectors and more growthy ones?
So right now we are we do have a little bit more beta than the market. Our view is this: the euphoria that we're in continues. We don't want to be super exposed to it, but we want to participate in it. So I think our beta at the portfolio level is probably about 1.05.
Yeah, 1.05.
So slightly above market. We don't have a huge amount of defensives in there right now, and cash is probably running at about 5%, so relatively neutral-ish for us. So we're not looking to make a big market call, but we're looking to participate in the continued sort of rally.
And the sector positions are mainly technology, consumer, financials. They're our main sort of positions that are and industrials. Those 4 sectors make up probably 70% of the portfolio today. But also on your question, it's also the market level. So the market, I know it is quite euphoric, and people say the market, and we're aware of it. The market's gone up nearly 20% for 3 years in a row, and it's looking like the construct doesn't look scary yet. Like, it looks quite good. The breadth and depth of the market is still quite wide. The valuation parameters of the market is still quite attractive. It's on like 18 times PE, growing at double-digit returns. The ROE is still about 15% ROE of the market in our mids and smalls universe. Our portfolio is around 20 times, with over 20% ROE, growing at double-digit as well. So there's nothing that's like screaming red flags in terms of valuation parameters of the market or our position relative to the market. But we do track that every single quarter quite religiously and try to make sure that the PE to G, PE to growth ratio makes sense. The PE to the ROE also makes sense. That gives you an idea of where the market, is extrapolating, and that's where you can get extended. But yeah, there's nothing that's a massive red flag at the moment that's concerning us.
Yeah, I think it's probably at this point worth highlighting the bifurcation between large caps and small and mid caps. So everything James said is absolutely true. Our small and mid cap universe today is trading on valuation levels broadly consistent with its 20-year history.
On free cash flow yield.
Yeah, free cash flow yield, PE, a lot of those different valuation metrics. Where you're seeing valuations looking very stretched is in large cap land. So if you look at the MSCI World, it's trading at valuation levels that are in the top decile of its long-term historical averages. So that valuation euphoria, you're seeing it predominantly concentrated in large caps. In our segment of the universe, our valuation levels are broadly in line with their history, and so is the growth rate. So for us, relatively speaking, it's quite attractive, and hence why we're more invested in small and mid caps. If we were running a broad cap or a large cap mandate, then we probably might have a different answer for you in terms of valuations running too far ahead.
So we talked a little bit about the sector balance. What about in terms of geography? I think in the recent webinar that you did, you talked a little bit about China. There's some ideas around, I think, the tech ecosystem that might get a bit of a wake-up call. What is your exposure there?
We have a little bit of exposure to China, but not in the technology sector. Right now we have exposure to China in the healthcare sector. Most
medtech.
Most of the technology names in China that are doing quite well are too large for us. So we're not really participating in the Chinese tech space per se.
Yeah,
but we
Alibaba is not a small cap.
It's not unfortunately not a small or mid cap. So we are slightly overweight China. Our benchmark is developed markets. So any position in China is an overweight. So we are slightly overweight China. We are overweight Europe, and then we're a little bit underweight the US.
Yeah. So you just brought up benchmarks, and as I was preparing for this podcast, I asked some of the asset owners what I should ask a small and mid-cap manager. And they said, what about performance comparison to ETF? Do you benchmark yourself to an ETF? Because these days there's an ETF for everything. So there is a quality value ETF. How do you look at that?
Yeah, QSML is definitely one that a lot of clients raise, and a lot of clients have that exposure in our universe. QSML has done quite well. We've done quite similarly to it. I guess the difference is that we are more balanced than the pure quality factor style. But mids and smalls has had quite a good rally, like overall, especially small caps. So that's, I guess, what you want to participate in longer term. But we definitely do look at it as QSML, a very nice product.
Yeah, I think for us, a single style factor is not really who we're looking necessarily at, because remember we're a blend of 4 different styles in there, right? So what we're ultimately trying to do is deliver a smoother return outcome for clients, and we've done that. So if you look back at calendar year 21, it was a very quality, growthy, momentum year. Same as 23 and 24, but 22 was the exact opposite of that. It was anti-quality. Quality sold off quite aggressively. It was pro-value. We outperformed in calendar year 21. We outperformed in calendar year 22. We outperformed in calendar year 23. Very different markets, and we delivered consistent alpha in very different markets. So if we were tilted to one style or another, whether it be quality or value or anything else, we would have had some periods where we did incredibly well, and we would have had some periods where we underperformed the broader market. And so you ride that volatility up and down if you're excessively exposed to one style. What we're trying to do is just sort of deliver consistent alpha year on year, independent of what the broader market is doing, independent of what style is doing well or what style is not doing well, independent of what rates are doing, what inflation is doing, what the Fed is doing, all those sorts of things. Our process is really more designed to give you that smoothness of return profile.
Yeah, fair enough. If we delve a little bit into your process, one question that I always like to ask, because it gives a little bit of a sense of how you think about companies, is can you think of a company that you've done due diligence on? It looked initially attractive, but as you dug deeper, it actually turned out, no, we're going to stay away from this stock.
Yes, so one we looked at earlier, probably towards the end of last year and into early this year, was Decker's Outdoor. They own a bunch of different shoe brands. The two most prominent ones, which account for over 90% of their sales, would be the Ugg boots, which we all know. And the other one is the Hoka shoes, which are those thick cushioned running shoes.
Lightweight.
Yeah, lightweight, thick cushioned running shoes. And you know, Deckers has been on an incredible growth profile for the last 4 or 5 years. Sales have been increasing double digits and accelerating for a number of years. Margins have been going up, returns have been going up. So everything kind of looked quite attractive. But when you sort of dug in a little bit below the surface, you realized the growth was predominantly driven by increasing penetration of Hoka. And they were first mover effectively. There was competition coming in because you can't really copyright a shoe design. You know, there might be certain elements of it, like, you know, Air Max or something like that. But you know, anyone can sort of come out with their own version of it. So competition was picking up. It wasn't an area that you could have long-term sustainable competitive advantages in, and it was predominantly, you know, single product risk. And trading on very high valuation levels because the market had woken up to that growth profile. So
we kept looking at it because we saw people running out of the gym, running down the street, running through the park. Everyone's wearing Hoka. You get into a lift, someone's wearing Hoka. So I'm like, Maroun, we've got to look at this Hoka again. But we did it for a year, and we spoke to the analysts probably 5 times about it.
Yeah, and then you know we decided to stay away from it, and then earlier this year. They guided to, you know, they missed their numbers by a few percent and guided to a slightly weaker than expected quarter. Still growing, but not 20% growth. It's going to be more like 10, 11, 12% growth. When you're a stock on 50 times PE, that's a very sharp drawdown, right? Yep. So the stock basically halved in the space of 2 months, even though it's still growing, but just not growing as quickly as what it was. And so for us, it was having the discipline to not get caught up in the euphoria and just look at it objectively, and ask yourself whether the fundamentals justified the valuation levels, and in our view they weren't.
So was that a buy moment when it halved?
Well, so we have looked at it again, but you know, at this point in time we're still sort of staying on the sidelines. Yeah,
and symptomatic of our process too. Like, we meet with all the analysts around the world. So the shoe market is big. So Puma's listed, Nike's listed, Adidas is listed. So we've got analysts in Japan. And ASICS, yeah. So Japan and Europe, and in this one, America. So Maroun and I saw what the Hoka brand was doing in our eyes with people in the lift, in the gym, in the parks. And the valuation was at incredibly high levels. But the context of shoes, it was very competitive. So Nike was having a tough time. All of them having quite a tough time. It wasn't an easy marketplace as well. So you had this Hoka brand that was doing something very different to the rest of the market, but then eventually the market weight or the market anchor basically brought it down. It was a very interesting one for our process and the conversations that we have between ourselves and the analysts. So it is quite an interesting example.
Yeah. Sounds a bit like I had a recent conversation where we're talking about the nature of cyclicality. And the comment was there around, well, some companies might not look cyclical, but their clients are. So maybe there was an element where everybody that wanted that shoe
bought it.
That shoe.
Yeah. Well, it's fashion risk, right? And fashion can be fickle. You know, what we used to wear 20 years ago and what we wear today, you know, very, very different.
Yeah. So I just asked you about what would potentially be a dud investment. What is your most your favorite investment?
Yes.
Well, certainly the most profitable, memorable one for us would be AppLovin, which is a very unique business that does ad tech. Basically, it's historically surfaced ads for you in the video game world. So if you're playing a mobile video game and you're getting ads within the video game, they're sort of the matchmaker that sit between the advertisers and the suppliers of ads. And historically, they've only surfaced you ads for other video games. So you're playing a video game and then you see an ad and, hey, you might be interested in this video game. Do you want to download it? What they realized is that they had the technology and the information to be able to also serve you ads for different verticals. And a vertical they got into, they opened it up in beta form in Q4 of last year, but it was e-commerce. So now all of a sudden you can be playing a video game and you might see an ad for, you might be interested in this shirt or this shoe or something like that, right? And it was, they opened it up in beta form in Q4 of last year, and all the feedback from the advertisers was that the return on advertising spend is very, very high. It's second probably only to Meta. Ahead of TikTok, ahead of Snapchat, Pinterest, Google even. So you're opening up a new segment of the market, all these e-commerce advertisers who previously wouldn't advertise with you. You're delivering them very high return on advertising spend. It's incremental new customers. It's not sort of customers that you're getting in different parts of the funnel. And this year they've gone from beta to now opening it out more broadly, and so we're seeing rapid adoption in that. And so the stock almost went up tenfold, over the course of 18 months. So it has definitely been very profitable for our investors.
So how would you classify a stock like that? Is that traditional marketing? Is it like AI that uses the algorithm to predict what you want to buy?
It's got AI in it. So the engine that powers is AI. So it learns. They're not obviously going to reveal their secrets in terms of what they do, but if you're on social media, it's relatively easy to know what you're interested in, right? Because you click on a bunch of different links. You might be following certain people. So if you follow, for example, a lot of different food bloggers on Instagram quickly works out that you're interested in food, right? And if you click on different articles about celebrity chefs and all those sorts of things, it works out pretty quickly you're interested in food. So it can service you ads related to food, whether it's cookbooks, whether it's a new restaurant is opening up, you might be interested in going to it. It quickly works it out. When you're playing a mobile video game, it's a lot harder to figure out what you know or what you're interested in, right? So they've got an AI system that sits underneath there, and it has been able to sort of figure out quite effectively things that you're interested in. How they do it, it's a bit of a black box, but that's the beauty of the AI model. So it's very hard to replicate. They're sitting on a huge amount of data. There's no one effectively, with the exception of a very distant player called Unity, which is a very, very distant number two, that has the data or the capabilities that they do. And like I said, they've just opened themselves up to a whole new customer base that can now sort of spend with them. So it's doing a lot of things. It's leveraging AI. It's giving customers who over the last 3 or 4 years or 5 years have only really been able to spend money with Google, Facebook, and TikTok in terms of advertising. Now you're getting another avenue for you to place ad dollars in, and you're getting incremental sales in it. So it's definitely doing a lot of good for its customers.
Yeah. So in terms of the process, is it a quality, value, transition, or momentum stack?
We call that an innovator. So basically went from transition to momentum. But remembering now, like normally quality we have as a multi-year high ROE business. This business ROE has gone from 10 to 60. But it's held that 60% ROE, which is in the top 1 to 2% of the world's ROE or return on invested capitals, for now 2 years. So that's what I say. And I know in my experience in the Australian market, if you find a stock that goes from like transition to momentum into quality, that's up 10x. So it's happened with Aristocrat, going back many years in the Australian market. It's happened with Abela in this marketplace, and it's happened with other stocks that we've had that were, you'd think they're momentum, they're cyclicals, but then they managed to sustain that ROE for a very long period of time. And that's when stocks can go up, 5, 10x as these ones do. So they are innovators that go from transition and momentum to quality, which is a very powerful structure. And even now, like you asked the question now, the EPS growth of that business is more than 50%. Like this year and then the year after. And they just did 300% return in the last 2 years.
Yeah.
So that's what I say, these stocks that have the earnings growth can go up a lot. But it's because, like Maroun's described, it is very innovative, what it is doing. It is doing something very different, but it is solving a problem for its clients and the world. So when you do that, you create a lot of value, which is what we're trying to find every day.
Yeah, for sure. So to finish up with, do you have any research projects on the boil? I believe you recently published a white paper. What was that looking at?
Yeah, it's a bit of detail. The white paper really looks at lessons learned that we've had over the years, the process, the asset class, and just takes readers through, I guess, the journey of what we try to do in the fund and the data to support that process ultimately. So that'll be coming out soon. And then recently, Maroun and I led the AI webinar, which is significant. AI revolution is a massive. They call it the fourth industrial revolution of the world. So that was a really interesting thing that we've done just recently.
Have you used AI in your own sort of research or your processes rather than investing?
I use it almost every day.
Oh yeah.
I've got Perplexity, Google Gemini. I use a little bit of ChatGPT and Grok as well. But Perplexity is my favorite of all of them. I've actually got a paid subscription with Perplexity that I use. And it's amazing. I mean, the amount of things you can leverage it for, it's just amazing.
Can you give one example of what you use it for?
Yeah, so I've got like a prompt. For example, let's say it's a stock. I want to get up to speed on it very, very quickly. We've obviously got internal analyst notes, so we can read a lot of that. But you know, even for private companies that we might not have notes on internally, I type in what I want it to do, and it goes out and it searches information for me, market shares, how those things have trended over time. It does a huge amount. Basically, it can do a relatively decent report on a business that would get you from a zero working knowledge to at least a respectable level of working knowledge, and it can do that for you in minutes. And so you can get up to relative good speed in 10 minutes, 15 minutes on a company after you've read it. And then from there, you can go and say, right, these are the key areas I need to look into. These are the key areas I need to dive into a bit, you know, because these seem to be the key value drivers. And then you can spend the next 2 or 3 weeks diving into just those key areas and making sure you have comfort around that. But it basically saves you that upfront work of about a week's worth of work, and it does it for you in literally minutes.
So there's definitely some productivity gains there.
A huge amount, a huge amount.
Fair enough. Well, Maroun, James, thank you very much for coming to our offices and for doing this podcast.
Thank you very much.
My pleasure.
This podcast was sponsored by Fidelity International. As such, the sponsor may make suggestions for topics, but final control remains with the Investment Innovation Institute. Thank you for listening to the i3 podcast. For more information, please visit our website at www.i3, that's the letter I, the number 3-invest.com. And don't forget to like, subscribe and review. Thank you very much.